So today, we're diving into the core wisdom of one of the most important investment books ever written, The Intelligent Investor. But here's the thing. This isn't going to be about hot stock tips or some secret formula for beating the market. No, it's about something way more powerful. Mastering the only thing you truly have control over, your own mind.
I think this quote from Thoreau just hits it perfectly, you know? It's great to have those big financial dreams, building your own castle in the air. But to make any of that real, you've got to build a rock-solid foundation first. And that is exactly what we're going to talk about today.
All right, so the very first thing we have to do is completely change our goal. Honestly, trying to beat the market or outsmart every other person out there, that's a losing game. The real goal is to focus on the things you can actually control. It all comes down to 3 incredibly powerful lessons that put you right in the driver's seat.
And here they are. It's that simple. Number 1, and this is the big one, avoid those huge, catastrophic mistakes you can't recover from. 2, aim for steady, lasting growth. And number 3, probably the hardest one, is learning to manage your own emotional impulses, the very things that cause most investors to stumble. This right here, this is the foundation for your castle. Take a look at this number, 1,900%. What on earth is that? Well, that's the gain you would need just to get back to even if you lost 95% of your money. Think about the dot-com crash in the early 2000s. Tons of investors saw their money just evaporate by that much. It's like a mathematical black hole. And it shows you exactly why Benjamin Graham's first rule is so critical. Your main job is to not lose big.
So, does this mean you need to be some kind of math genius to avoid these huge losses? Not even close. You know, one of the biggest myths in finance is that you have to be brilliant at crunching numbers to succeed. The truth? It has so much more to do with your character.
Which leads to a really important question. When Benjamin Graham uses the term intelligent investor, what does he actually mean by that? Because the answer, well, it's probably not what you think.
And there you have it. It's got almost nothing to do with your IQ or what you scored on a test. It's about your temperament. Are you patient? Are you disciplined? Can you control your emotions and actually think for yourself? Like Graham says, it is a trait of character, not of the brain. You don't have to be a rocket scientist. In fact, as we're about to see, sometimes I can actually work against you.
And for the perfect example, look no further than Sir Isaac Newton. I mean, we're talking about the guy who literally discovered gravity and invented calculus. If anyone had the brain power to win at investing, it should have been him. And yet, he made one of the most famous investing mistakes in all of history.
So here's the story. Newton actually got it right at first. He invested in the South Sea Company, which was at the center of this huge speculative bubble in the 1720s. He sensed things were getting crazy, and he cashed out, doubling his money. A smart move! But then FOMO, the fear of missing out, kicked in. He watched his friends keep getting richer and richer, and he couldn't stand it. He jumped back in near the very top of the bubble and ended up losing a fortune, over $3 million in today's money. The smartest guy on the planet, taken down by his own emotions.
So, Newton got caught up in the madness of the crowd. Now let's talk about another classic trap, one that really plays on our emotions, the appeal of the sure thing. You know, that one industry that everyone just knows is going to be the next big thing?
Graham's insight here is absolutely timeless. Just because you can correctly predict that, I don't know, the internet is going to get bigger, that doesn't automatically mean you're going to make a ton of money from it. Why not? Well, because by the time an opportunity is obvious to everybody, the prices of those stocks have already been bid up into the stratosphere. The easy money is already gone.
And here's what that looks like in the real world. During that same dot-com bubble, the so-called experts were saying the most insane things. One guy promised his fund would go up 50% a year. Another one told skeptical investors they were driving a horse and buggy. And my personal favorite, one guy even said to just throw out everything that Graham taught us. So what happened? Total devastation. Investors who listened to this obvious advice got absolutely wiped out.
So we've seen a certified genius like Newton completely fail, and we've seen how chasing the obvious big thing can lead to absolute disaster. What's the common theme here? It's us. The biggest risk in investing isn't some crazy market swing. It's the person staring back at you in the mirror.
And Graham just says it perfectly. The investor's chief problem, and even his worst enemy, is likely to be himself. That's it. That's the ultimate truth of investing. It's not about mastering complex charts and algorithms. It's about mastering our own instincts, our own emotions, and our tendency to just follow the herd. That is the real battle we have to win.
Okay, so, if we are our own worst enemy, what's the game plan? How do we actually fight back? Well, that brings us to our final and maybe the most powerful mindset shift of all. It's about completely changing the way you look at a falling market.
Just look at the difference here. The crowd, the average person, they get excited when prices are high and going higher, and then they panic and sell when prices are low and falling. It makes no sense. It's like rushing to the store the day after a big sale ends to buy things at full price and then returning them in a panic when they finally go on clearance. The intelligent investor does the complete opposite. They get nervous when prices are high because stocks are expensive, and they welcome a down market because everything just went on sale.
And this is the ultimate mental flip. A bear market is not a crisis, it's an opportunity. When stock prices are lower, your risk of overpaying goes down and your potential for future returns goes way up. It is, believe it or not, a much safer and saner time to be putting your money to work for the long haul.
So when you put it all together, avoiding big losses, controlling your own behavior, and remembering that you're the biggest obstacle, it changes everything. A falling market doesn't look like a disaster anymore. It looks like a sale. So I'll just leave you with this one question. The next time the market is having a sale, are you going to be prepared to be a buyer?